I want to go over some accounting basics with you, which are all found in Chapter 1. And if you read over Chapter 2, you're going to see a lot of the same concepts discussed more than once. So the first thing that I want to reinforce here are the types or the categories of accounts. And the first one is assets, and then we talked about liabilities. Owner's equity account, there are two of these, which are capital and drawing. Then you have revenues and expenses. And I want you to learn these types of accounts in this order because when we do the trial balance, you're going to actually create the trial balance in this order. So first you have assets. These are things that you own, resources that you own that are going to help you make money. Liabilities are things that you owe. Owner's equity. This has to do with the owner's equity in the business, and drawing has to do with the money that he takes out. Revenue is money that you earn, and expenses are costs that you incur while you're doing business. Now, the way we remember normal balances is an acronym, all elephants drive little red convertibles. Okay, and the A stands for assets, and that means if you do a T account for an asset, then it's going to have a normal debit balance. So increases are going to happen on the left side, decreases happen on the right side, and you know that because A is on the left side of this sentence. Liabilities are represented by the L, so the normal balance of a liability is the credit side. Owner's equity has two different accounts. One is capital and one is drawing. And these have different normal balances. The capital account has a credit balance and the drawing account has a debit balance. Revenue is represented by the R, and all revenue accounts have a normal credit balance, and expenses is represented by the E up here, and expenses have a normal debit balance. So you must memorize this before journal entries are going to make sense to you. There are three different financial statements we're going to learn about and create in Accounting 1. The first financial statement we're going to create is called the income statement. And you must memorize these in order. And so we create the income statement first, and you need to know the formula for the income statement is revenue minus expenses equals net income. Now, you won't see this in the book as the formula, but I'm just going to tell you it's the formula because most of you who've been in math classes know that you should memorize the formulas. So that's why I'm going to call it that. And what you do with the income statement is you're going to list out your revenues, all your different accounts that keep up with the money that you earn. And then you're going to take away all your expenses. And the expenses are going to be listed from greatest to least, with miscellaneous being last. And that's going to give you, bottom line of your income statement is going to be net income. We hope. If your expenses are more than your revenues, of course, that would be a net loss. And you need this amount, net income, to create your second financial statement, which is called the Statement of Owner's Equity. And the Statement of Owner's Equity is going to help you find your ending capital balance. So you're going to start off with your beginning capital balance. And if it's a sole proprietorship, you just have one owner, so you only have one capital account. And then you'll add any additional cash or any additional investments that the owner has put in. And then you're going to add net income. Very important that you know that net income increases owner's equity. And you find net income by creating that first financial statement, and then you're going to plug it in here. So you actually use the data from the first financial statement to create the second financial statement. And then you're going to take out any drawing. And remember, the drawing account is where we keep up with the money that the owner has taken out of the company. And when you add those and subtract out drawing, then you're going to get the ending capital balance. And you're going to need the ending capital balance to actually create that third financial statement, which is called the balance sheet. And the formula for the balance sheet is the same thing as what we call the accounting equation, and it's assets equal liabilities plus owner's equity. So what you're going to do with the balance sheet is you'll add up all your assets, and you'll list those out and find the total there. And then you'll list out your liabilities and your owner's equity. And your owner's equity is going to be that ending capital account. Sorry, I messed that up. Capital account. Your ending capital balance. You're going to add that plus your liabilities, and that should equal your total assets. And so if your assets equal your liabilities plus the owner's equity, you're actually going to double underline that balance sheet. So that takes you through your types of accounts, your normal balances, and the 3 basic financial statements. So, hope this helps and gives you some information.